Welcome to The New Next, a podcast that addresses current events and how they will impact the future. Co-hosted by the inquisitive public speaking champion, Mike McVeigh, and energy, economics, and technology expert, Matt Jensen. Join us as we explore all things energy, economic, tech, and political, and how they will affect our future.
So the housing market is crashing, says KPMG chief economist. And this is a good thing or this is a bad thing?
Of course, it's not a good thing, Mike.
I don't know. Maybe it's just a sense of perspective, because I know you're going to tell me how I'm wrong, but why is this not a good thing?
Why is the housing market? Maybe you should tell me, why would a housing market crashing be a good thing?
Well, one, I don't necessarily know it. Like, I feel like there's been a lot of people paying way too much for houses lately.
Yeah.
So I don't know if the crashing is the fact that now the prices are going down, or if the crashing is that the prices are going up, or people are just not buying.
Oh, yeah.
I don't understand it. So this isn't me like making fun of it. I really don't.
Yeah, no.
I don't know.
Yeah, the markets, this was like a key focus of the Federal Reserve, was basically slowing down the housing market and trying to get pricing under control. The rate of hikes has been very fast. So historically, you have kind of more tempered hikes. Like, clearly they wanted to do it fast and quick, and then maximum pain, and then kind of slow down a little bit, see how the market reflected. Since housing is, such a large purchase that's typically financed, there's very few cash buyers. The interest rate really makes a big determinant on whether or not people are purchasing new housing or loaning basically to remodel it, upgrades and stuff. So pretty much everything that was popular during COVID times. Yeah. So we've talked a lot about this podcast, and maybe I'll splice in some of the old stuff, but we talked about, I think, like earlier in the year, like February or March, about how we expected housing to go down because of the interest rates being increased, just kind of like straight line.
I remember that.
And then we talked about it a couple times, but it's been really looking at the numbers state by state, both on new housing permit starts and existing home sales, pricing, especially in the cities like Boise, for instance, Seattle, that had major price increases during COVID. A lot of those were driven partially by the COVID trends, where people were remote working and trying to get out of large cities, but also on kind of like this cheap money and readjustment factor, where people wanted to move around and stuff like that. So while they could. So now that the easy money is gone and there's essentially more supply on the market, like we've been talking about would happen for months, prices have really crashed in a lot of the, I guess, more inflated or more competitive in recent years markets. So, like if you bought maybe a house in one of the larger metropolitan areas, or like a Boise, for instance, where housing prices went up 30% plus, basically a year. If you bought it at the height, say you moved, got a new job, bought at the height, some of these people are very underwater on their mortgages. So it's very unfortunate. So, and then also it's just kind of an interesting thing, because if you look at housing prices, and maybe I'll pop up a chart here in the future, or add one if I can find one, or maybe I'll put one together. So we'll see how fancy I get. But
Chart Master Matt.
I think like in a lot of markets, housing prices could fall 50% and still be basically above trend for pre-COVID levels.
Okay, so I'm going to have to stop you now.
Yeah.
You're using really cool language that I don't understand at all.
Okay, let's pick it apart.
So, yeah. And I know everybody else is probably like, oh, this is the easy stuff, Mike. I'm like, yeah, and I don't understand the easy stuff. I might understand more complicated. All right. So the prices are falling, but they're still above trend. Is there another way you can relate that, or can you say that differently?
So in a economy kind of in a box, right? If you're modeling an economy that doesn't have crazy booms and busts, which isn't realistic, but a lot of times economists simplify it to a normalized average trend. So say a rule of thumb, right, is maybe inflation will go up 2 to 3% a year. So if you're showing a normalized trend, that's basically a straight line of, inflation, showing inflation increasing 2 to 3% a year. In actuality, inflation may be 1% this year, 8%, and then minus 2% another year. So if you want to look at kind of a line of normal growth over time, you just kind of plot that curve and then see how it fluctuates around that curve on the actual prices. And that kind of shows the swings up above or below trend. So, if at 2009, a house cost $100 and we expect housing prices to increase 5% a year, we expected it at the end of the year to be worth $105. But in certain markets, it was actually worth $170. So the housing market is crashing, but in some cases, there's people that thought it was going to be $105 and now it's still $125. So it's above trend, but it's much less than $175 that it was at. So it's kind of all relative. So when you see these huge price gains, like historically, like people feel more wealthy because, maybe your house was worth $1 million and now it's worth $2 million. That's basically another $1 million that you have for your retirement before taxes. Right. So it makes you more inclined to spend. Psychologically, even though you didn't lose anything, there's a feeling of loss because it was worth $2 million and now it's only worth $1.5 million.
Okay, so this is like baseball cards then, basically.
Yeah.
Okay, so it's kind of, you say that, and I'm like, oh yeah, it makes perfect sense now.
Or Beanie Babies. So remember that Beanie Baby craze?
Baseball cards. That's
or baseball cards. Well,
but Beanie Babies for the rest of y'all.
Yeah, I feel baseball cards are a little bit more stable over time and value than stuff like that.
Yeah. Now, in the mid '90s, there was a baseball card crash that completely
I remember that,
reset the market, and I want to say it was like 40 to 50% of all baseball card and trading card stores basically closed down across the nation. So that makes a lot more sense to me. So basically it's the fact that, so crashing is that really the right term? Would just the saying that the market is volatile, would that be a better term?
Well, I think it's relative, and we haven't really seen it out yet. The pace of stuff falling in the real activity in the sector. So we've just talked about pricing, right? But when this kind of dislocation, price is falling because there's a lack of demand, because people can't really get the cash to buy the houses that they were before. Right. So you think about how that's rippling through the sector. I don't think it necessarily is going to have as big of an effect as some people are saying, because there's been such a basically a lack of construction labor that's really hindered a lot of the growth over the last a year and a half.
That's what we talked about recently as well. Yeah.
Yeah. But, you know, contractors, stuff like that, are seeing a lot of their businesses dry up in certain areas. But, you know, in a lot of these, I say, wealthier areas, there's still people that are making a lot of money and their house is still worth a lot more. So they're still going to spend it. So it's like, I honestly know a bunch of people that are doing remodels right now. So, but they're probably in a different financial position than I think the general market. But it's, yeah. So, yeah. So basically, it's a wait and see. But
Gotcha.
the market has stopped at such an extreme level, and that I haven't remembered except for around the financial crisis period. And
that sounds more relatable, like something I can understand more.
Yeah. But it's different than the financial crisis in that in the financial crisis, you had so many people that bought in at high valuations.
Right.
Like in this area, the people that have bought in the last year and a half might see precipitously lower housing prices off that amount. But, you know, it's kind of the economics kind of depend on whether or not it was good to buy at that high price or now because the interest rate is so much higher. But buying it before COVID would have obviously been the best, basically, you know?
Right.
So it's just, I think a lot of those people that were like, I need to get out of the city now. I need to, you know, do something really rash and stuff. And not super well thought out. Those are the people that, you know, with using the phrase are kind of like holding the bag, so to speak, on this Fed action.
What's interesting is just while we're talking, I got an email from my realtor who was asking, are you still interested in knowing how much your home is worth? And I've never contacted him asking how much my home is worth, but I get weekly or every couple of weeks from him. And, so I just thought that was funny. Literally while we're talking about it, I got an email from my realtor asking about home worth.
That's funny.
First world problems.
Yeah. Activity is really slowed down. So it's just like, I think it's a time where people are going to be a little bit more aggressive on getting business. And, but yeah, it's interesting. So the market's crashing real estate wise, but it's being disproportionately felt depending on what part you play in the market.
Okay.
And both on the consumer side, but also, you know, the people that build and sell, transact the houses.
So I guess I get, like, if you were expecting to sell your house for a huge amount and it's crashed, that's devastating. Even if you're getting more than what it's worth or whatever, whatever the trend was or whatever that, but I mean, that's part of the game, right? That's part of what that's about. I mean, isn't this a good thing for more, since we're talking about like these 4 million families and stuff that are looking for a home, isn't this a good thing that they're going to be more likely to buy those homes?
Well, so there's still supply constraints. So price may be going down, but there's still not enough supply to fit that single family home.
Right.
Stuff.
But I mean, but this makes it easier, at least where it's going to help the numbers balance out a little bit more, right?
But also the credit environment too is worse, so that when you could basically borrow at a couple percent before to build out like a whole complex of single family homes, like now it costs you a lot more money, and that hits against your economics. So it's there, you know, builders will build, but it's going to change their behavior. And what I think is that you'll see more focus on a lot of builders for that higher end area, because those are kind of like if you're good at what you do, that's the stuff where you can basically be paid a premium for premium finishes and kind of like the stuff like that. Yeah.
Okay, that's fair. I guess in my still distorted view, which you can go back and read some stuff or listen to some of this stuff, it sounds like to me that things are balancing out. But
yes, they are balancing out.
I get that it's causing other issues, but I guess that's part of, I don't know, that just seems like that's what life is you're constantly adjusting to, you have a dramatic moment that happens in your life, and you adjust to it. And once it starts getting normalized, something else goes wrong, you know?
Well, so like my thought is this is kind of like, you know, when you have a hammer, everything looks like a nail sort of situation. Right. The Federal Reserve has very limited tools, so they can control the interest rates, or they can actually buy stocks and bonds, intervene in the market, and or, you know, sell also. So those are basically the two tools that they have. They're using the interest rate tool here, which tends to have a longer term effect. They call it, we've talked about this before on the podcast, but the monetary transmission mechanism.
Right.
It's the name for the process where the interest rate is cut at the Federal Reserve, and then it kind of trickles through the financial system. And then a year and a half later, that's where it affects kind of like the end lending, you know, technically. But usually people make their adjustments more upfront based on future expectations of the interest rate. But from a practical sense of the money effect flowing through the system, rather than the psychological effects, that's the monetary transmission mechanism that usually takes a month or a month and a half. So they don't have a lot of really near-term things that they can do besides manage expectations. They're really a communication entity because they want to communicate the future now so that people make expectations now, because the actual actions that they take from a fundamental sense take a year and a half to flow through the system. Yeah.
That makes sense. Yeah. And then my weird sense of stuff. So,
yeah. So to go back for starting that, when you have a hammer, everything looks like a nail. There's so many different parts of the financial system or the housing market that I think is kind of fragmented and stretched out now. Part of that's due to COVID, but things have been really, I would say, skewed. We were talking about some of the bubbles that we've had in lumber, prices, you know, just the changes in behavior for people buying stuff without any sort of like inspection and stuff like that, you know, just crazy things that I wouldn't do. But it's kind of adjusting one thing in the market, but not touching these other things, which I think are really important. And my hope is that that people don't lose sight of some of the structural problems that we need to kind of fix regulatory wise, both at the local and federal levels, and then also kind of through the banking sector, but also kind of maybe more demographic fundamentals of America and the incentives that developers have to build the housing stocks that we actually need to house the citizens to have a good life from a fundamental level, rather than, you know, maybe a life of luxury for us lucky few.
If you would like to learn more about the New Next podcast, find us at thenewnextpodcast.com, where you can suggest a topic you would like for us to cover. If you enjoyed what you heard, share the podcast, tell a friend about it, or rate us with 5 stars.